Assalamualaikum and hi everyone. My name is Khalif and I'm here to present about two simple things, which is the transfer of capital and stock markets. Let's move on to transfer of capital. Transfer of capital is very simple. It's basically when an amount of assets or funding is transferred from one funding resources to another organization in order to fund their projects. Projects such as infrastructure, such as buildings and whatnot. It doesn't matter what it is, but they do have transfer of capital in order to fund them. Transfer of capital is divided into two ways, which is the direct method and the indirect method. Let's move on to what direct method means. Direct method is when the funding is reallocated, but it does not involve any intermediaries. Intermediaries are such as banks, where they are pathways that the money is flown through in order to fund these organizations in the first place. Examples of direct transfer capital are initial public offerings, private placements, and even peer-to-peer lendings. These are examples of direct transfer where funding resources does not need to involve any banks and can immediately fund the organizations in the first place. So I think I'll leave it to Shafiq to explain about indirect method after this. Thank you.
So I am going to talk about transfer of capital indirect. The meaning is movement of capital or assets from one entity to another through a direct exchange or transaction. For example, investing in a fund, taxes, loans, or investment. That's all.
Thank you, Mr. Shafiq. So now let's see what the comparisons are between the direct and indirect method for transfer of capital. The first thing we can see is the role of intermediaries. Direct method actually has does not have any intermediaries helping them. This is because that they directly transfer the funds directly towards the organization. They do not need any banks, any loans or brokers in order to actually do this. Second thing is the cost. Since direct method does not need any bank, they have less costs in order to actually utilize the banks in itself. Indirect method is more costly because they use banks in their funding. The last thing we can see is the risk exposure. Direct method has more risk because they do not use banks. Indirect method has lower risk because they have a stronger, more secured line of transfer of funds because they use banks and funding and loans and whatnot. So those are the comparisons that both companies can use direct and indirect method for transfer of capital. Now moving on to stock markets from the girls.
The next one is stock market. So, stock market is a marketplace where the investor purchase and sell stock or ownership share in the businesses that are publicly traded. It is essential of the financial system because it gives the businesses the ability to raise money for expansion and giving investors the chance to get their money back. What is organized stock exchange or known as OSE? So, OSE is a marketplace where securities such as stock and bonds are bought and sold. OSE can facilitate the efficient transfer of ownership and issuance a new share, but in Malaysia, only Bursa Malaysia has the authority to do so. OSE also tangible entities, which provides a physical marketplace and physically occupy space. This can be referred to physical infrastructure and location that facilitate the trading of securities. The advantage of OSE is liquidity for investor. It is because investor can easily buy or sell securities and convert their investment into cash quickly. The disadvantage of OSE is high cost. It is because they have to pay for a listing company security and also audits.
What is OTC? OTC stands for over-the-counter, which refers to a system of computers, brokers, and electronic networks provide a communication link between the dealers and the brokers. In simple terms, it describes things that don't go through big official system. It is all about skipping the middleman. The advantages of OTC are customization, which means contracts can be customized to meet specific needs that any other party involved. Next is lower cost. Exchange fees can make OTC trading cheaper. For these advantages are higher risk because OTC markets are less regulated than exchanges, which increasing the risk of fraud or market manipulation. Next is lack of transparency because of prices and terms are often not publicly disclosed, leading to potential unfair pricing or hidden risk. There are three comparisons between OSE and OTC. For the first one, trading venue, physical or digital location for their platforms. OTC is decentralized since they occur in electronic system. Next is in regulation. OSE is highly regulated compared to OTC with operational requirement of initiate. Lastly, in liquidity, OSE has a higher liquidity compared to OTC due to a large trading volumes.